Welcome to episode 27 of Insights for Business Owners. This month, we have Daniel Tasman on the podcast, who's CEO of Beacon Services. Daniel, great to have you on the podcast.
Thanks, Dave. Yeah, great to be here.
Awesome. Well, we're going to talk about taxes and tax planning in deals, but tell us a little bit about the deal you did, and then we'll get into kind of how you thought it through from a tax perspective.
Yeah. The classic self-funded search story, found a lifestyle business from somebody that was looking to exit after 20 years. They actually uniquely had two entities that were acquired in one SBA 7A transaction. And one of the things that I was looking to accomplish was plan for an exit. Yeah. So I know that some people acquire businesses and they intend to keep them forever. Mm-hmm. And I just knew that may happen,
right?
But it's more likely I'll want to exit at some point, and I have investors and that they'll want to exit at some point. And so we don't have a put, which I know has been like a popular thing people have been talking about in the search world. But there is a clear finish line. There's not a finite period of time, but QSBS enabled the best outcomes for our investors and for me as an entrepreneur. And so started planning for that.
That's great. Yeah, no, and I love like the fact that you said during the search you planned for the exit, which is hard, right? Because the search is so all-encompassing. But I think that planning can just benefit you so much in the long term, right? I mean, I imagine that like is something you would really recommend.
Yeah, definitely. I mean, I don't know, it's like kind of cliche, but if you plan for where you want to be, then you can get there. And, it's easier said than done, but something like QSBS, you have to be really intentional because it's easy to lose the status.
Yeah.
And it's kind of an informal thing until it's an exit. So
until it's not. Yeah, exactly.
Yeah, until it's not, exactly. So it's one of those things that like you could fall forward and be okay.
Right.
You could very easily not. And so like an example of that is, and I'll just tell you what I do. So
yeah, of course, yeah.
I acquired Beacon Services, which is the market leader in marina Wi-Fi access control. So like key fobs and controls of doors and gates and all that,
nice.
Parking passes, and then also surveillance systems. And so what has really evolved is we're really an outdoor Wi-Fi company. As like a bigger picture, that's where we're going. And we're basically B2B to C. And so, there's a layer of complexity that's involved in like how we service our clients, but we're an MSP, so an IT company.
Yeah.
And, I guess that's like the background. And so one of the things that's important to know is that QSBS status is all good and well, like we qualify. Mm-hmm. However, if we were to expand and employ or, even acquire low voltage contractors, they technically would push us out of status. Yeah.
Wow.
So it's one of those things that's like, it would help us as a business to, build vertically, reduce our cost of goods sold, right, through like our installers. However, it's more important to me to keep the QSBS status. And so in the nature of that, like we can plan ahead.
Yeah. Well, and let's, step back and make it real simple. Like, what is QSBS? Like, what is this? What does this acronym mean?
Yeah, qualified sale of business stock, and it only applies to C corps. Yep. So if you have an S corp or an LLC that's not taxed as a C corp, actually, I don't even know if an LLC not taxed as a C corp applies or not, but only for C corps.
C corps.
So,
yep.
Just take that away.
Yep.
And one of the things that I think has made that not be ideal to a lot of searchers over the years is that, or like at least non-traditional, is that there are corporate tax rates and double taxation when you're sending out distributions. So people don't want that. They hear that and they cringe. They're like, oh, we would never do that.
Right.
But and I'll talk a little bit more about QSBS and what it is in a second. But one of the reasons that I'm not deterred by that double taxation is because one, corporate tax rates are historically at all-time lows.
Right, like the 21%, I think, right?
21%
Yeah.
federally.
Yeah.
Yep. And
Mm-hmm.
so with QSBS, if you maintain status, you hold it for 5 years, um, and they're original shares, and
Yep.
you're in the right industry, so not
Mm-hmm.
professional services,
Yep.
you're not a CPA or a lawyer or whatever.
Darn it. Yeah. All right.
Yeah.
Yeah.
Sorry, Dave.
Yeah.
Then and your gross assets stay below a certain threshold, and
It's
that you're
50
using
million, something like that. Yeah.
50 million.
I think
Yep.
so. Yeah. Yeah.
Yeah, which is not hard for a self-funded searcher to
No.
maintain, right? So,
No.
um,
And if you get past that,
first
life
world
is
problem.
good. Yeah. Yeah. It's like
Exactly.
you'll be all right.
Yep. And then the other thing is something about gross assets. You have to be using 80% of the gross assets in
Yeah.
the business,
Yeah.
which again is not that hard for a searcher because you're dealing with a much smaller pool of assets most of the time.
Right.
And usually it's pretty efficient, right? It's pretty lean. So,
Mm-hmm.
the vehicles that you're using or the cash in your bank account, you're not just hoarding cash in treasury somewhere,
Right.
right?
Right.
Kind of the gist. And yeah, so those are all good.
And then you get on the back end, you get this big capital gains tax exemption, right?
Yeah, exactly. So that's the prize. So
Yeah.
not have any capital gains paid on a stock sale, only stock sale.
Got to be stock sale. Yeah.
So as a searcher, if you're acquiring a business, ideally, not always, but ideally, you're doing an asset deal.
Mm-hmm.
That comes with all the depreciation and all the fun things that make the deal more accretive to you as the entrepreneur and your investors. But yeah, you can only sell, and you have to know this going in,
right,
as a stock sale.
Yeah, yeah, and you get, what is it, 10 million tax free on the sale, on the gain, right? Yeah.
So the 10 million or 10 times the initial investment. So
okay,
let's say that you and your investors put 500 grand into the deal.
Mm-hmm.
So 10 times that is 5 million, or the 10 million. So
I see. Okay.
As a default, you will at least get 10 million in potential uncapped cap gains. So you will not pay tax on that federally.
Okay. Interesting. So I didn't know it's 10 times the equity injection. Is that
it's the equity injection.
Yeah. Yep. Okay. Interesting. So this seems like a no-brainer. I mean, but how far along did you have to start planning for this? How did you run numbers versus double taxation, C Corp, level? What kind of planning did you have to do for this?
Yeah, so I started thinking about it back in May. I went to an event and was talking to somebody that backs search funded deals, mostly traditional.
Yeah.
And I'd already been thinking about it, and this investor said they think that every searcher across the board should only be doing C Corp and aim for QSBS across the board.
Yeah.
And that stuck with me, and I just started digging in. QSBS is one of those things you can Google it, and you can learn a decent amount to understand what's involved and watch this podcast.
Right. Yeah.
But there is a lot of nuance that's like not readily available online, and so it's good to obviously talk to a tax attorney or a lawyer who's been through it. I think that a lot of people, even a lot of CPAs and stuff that I've talked to, don't have a strong grasp for what it is. And so really, you have to be super responsible for this as the individual entrepreneur. Probably goes without saying, but if you don't own it and make sure that people give you the answers that you need, even if you don't know what they are, it's going to be hard to make it happen. Because, I just look back at how I was trying to plan around this and looking at what future acquisitions might look like after we closed on Beacon. And, there was some information that I only learned about after we closed. So fortunately, we still maintain our status.
Right.
Could have dodged. Well, could have been a fatal blow to.
Wow, that's interesting. Yeah. So that's helpful, because even when you're doing due diligence, and you're digging into the company, one of the things you're looking for is there something that's going to throw me out of QSBS? Like, that's an interesting, thing to, just one more thing to be focused on.
To add to your list of things.
Yeah, exactly.
Yeah.
So when you ran the numbers, because you actually said, we've talked and you said you like penciled out tax benefit versus potential double taxation.
Yep.
What was the difference? Like, was it significant?
So it always depends when you do financial planning, like how quote unquote realistic you are about your numbers. So, being very conservative, but when we were being very conservative, there's basically this foundational piece for me, which was if we know that we're going to exit and get this outcome that we want. So essentially it's like selling for even a bigger number,
right?
Because you're not being taxed on it, right? So you can sell for a lower number and hit the same amount of
and
money.
you actually, that's a good point.
Yep. So that's how I was looking at it. And to me, I didn't need the big, I mean, I'm paying myself a salary,
Sure.
right? And we plan to have distributions every year if things go well, but we don't have to make a killing before we exit. So the goal is, let's make the exit as big as possible. We have recurring revenue. That's where we want to focus and get the biggest multiple on an exit. So along the way, if we can make sure that that we're not actually throwing money into our pockets, but actually throwing it into growth, that's what C Corps are great for. So there's going to be a little double taxation because the government has to get paid. That's part of the rules of running a business.
Yeah.
But one of the things that's really great about C Corps is that as long as you're throwing the money into growth, it doesn't count against you. And so, that's one of those things that, if that's part of your strategy, then it fits really snugly.
That's a really interesting point, because like if you're not distributing any cash, you're only paying one set of taxation, which is the corporate tax rate.
Yep.
So if you're patient, and if your investors are patient, then there's really almost very little downside.
Yep, exactly. So just like be diligent about maintaining status, and then know what set the expectations with your investors up front on like where you want to be with whether it's distributions and growth. But for us, we prioritize growth. And so for us, it's easy to take the path that we've taken. And I think, if you know what you're getting yourself into with the business, which I know sometimes is not as straightforward,
right?
There can, if you buy a distressed company and it doesn't have a clear path to what those distributions might look like, maybe this isn't the right path. But you can always take the distributions and invest in growth later. You don't have to sell in 5 years. You could sell in 10 years or 15 years. And actually, this is also really cool, is a lot of VC companies that are savvy, like VC-backed startups, will end up, every round of funding, they create new shares. And so those new shares, as long as they're held for 5 years, all qualify.
Oh my gosh. Are you serious? I didn't know that. So you can this $10 million tax benefit can be used many times on the same company, just with different shares of stock.
Yeah, exactly. So, if you acquired another business as part of your holdco, as long as you're buying it and it is within the status, then you're going to be all set.
That is really cool. Now, let me ask it from a different angle, which is, how attractive is knowing about this and then, pitching it to investors? Like, does that enable an easier sell to get investment?
Yeah, I mean, nobody's heard of this, right? Like, so it's been around since 1993.
Yeah.
It is more valuable than it's ever been because of the low corporate tax rate.
Right.
But I think most people just have never heard of it. Like when you start a business or you run into somebody who's an operator, a lot of times it's through an LLC, passive income, or it's an S Corp where there are advantages, but it's a special subclass of corporation. And this is really meant for, I mean, I don't know, super patriotic here, but like to drive the American economy is
100%. Yeah. 100%. Yeah. Well, and I mean, it's a bigger thing, but I actually think this whole SBA guarantees and all that all fits in with that. I mean, I think it's enabling exits for a whole generation of business owners, which would be much harder if there was just traditional bank financing, without a guarantee. And then this on the back end can give you this great, tax benefit. We say, hey, thank you for creating all these jobs, creating all this, benefit. But you got to know about this stuff.
Yeah.
Yeah.
Agreed. Yeah. Nobody's going to give this to you
No.
in the traditional, like, due diligence process. You have to really be like aiming for it yourself as the entrepreneur.
Yeah.
Um,
Yeah.
because there's a lot of nuance to it that when
A
you
lot.
start asking questions, you
Yeah.
learn and you're like, oh, that could be bad if I want to keep this, or
Right.
that's not going to make sense to us because we want the money now.
Right.
You know, there's a lot of things to consider.
Right. Well, and something you said too, it's like a broader search kind of idea. But I think, and this is why I, really loved working with you, and I think you just the right approach is the searcher has to take ownership of everything. I think as a team member in the deals, we're trying to obviously look out for your best interests as much as possible. But ultimately, unfortunately, for better or worse, the buck stops at the searcher. And you have to keep us all honest, and all in line, because part of it for us is like, hey, we're working on 25 deals at once. Am I remembering every last detail of your deal all the time? Unfortunately, no.
Right.
And I physically couldn't. But because you took ownership of everything, you got the best possible outcome.
Hopefully, we'll see in 5 years. That's the hope that we did the best possible outcome.
So what advice would you give to searchers, about this tax piece, now that you've done it, at least on the front end?
So you need to find a good tax attorney.
Yep.
So, there's your M&A attorney, obviously.
Yep.
You've got your tax attorney. The tax attorney is going to be kind of the magic bullet to understanding broadly what makes sense and what is not allowed. They'll keep you, quote unquote, keep you honest on, will this pass the IRS or not?
Right.
Because that ultimately you need to know that you're going to be okay at an exit, because nothing is tracked during this. Like,
so you don't know until the end. Like you might trigger something. Wow.
Yep, exactly. So I have seen in my research that there's something called a QSBS attestation letter, which you don't have to have. You don't have to have that. It's like, I think that's more for the investors to be able to feel comfortable than anything else. It's not a legal requirement, and that concerned me after I closed on the deal to see that was a thing. And my tax attorney didn't provide us one. But in the end, I asked for one just to make sure that we're good. But they told me that it's not a problem. It's not required. It's really more for your own confidence as you move forward, because the status is a little bit abstract. Like, it's not not something you're filing every year. It's just when you exit that you claim it. So
you wow.
So it's just making sure you kind of like keep the receipt trail, if you will.
I get it. Yeah. And would you say you definitely need a tax attorney, or is a really high level smart CPA enough, or do you need both?
I don't think that I would trust just a CPA. Not because they're not qualified, because if they are, as with everything, if you're an expert in a specific field, an M&A CPA, like, they're going to know a lot. But in the name of de-risking probably the most important aspect of your deal,
exactly.
I definitely would make sure that I have somebody who's well versed in both accounting and law. And so the tax attorney is great, and then other people can be helpful. But the more people that you can bounce things off of, probably the better you're going to be in the long run. Because people forget stuff. Like you said, everyone's got a lot of things going on, and their focus is not to make sure that you have QSBS that's valid. So it's easy for things to slip through, and QSBS is actually like kind of complex. So
it is.
We've simplified it for this conversation.
We've boiled it down, and I'm no expert. I'm the first to say, like, go find an expert. This tax attorney, sounds great, or and then probably just a tax attorney. I mean, because at the highest level, you're talking about like a $2 million tax benefit, right? I mean, that's worth spending a little money on up front.
Yeah, exactly. I mean, you could easily be essentially like creating some arbitrage on getting an extra, 2 multiple on your exit or something. Right. So it's super meaningful. And I think that it deserves its own special attention. And, it's not fun to like be thinking about adding another deal fee, like a tax attorney, another $5,000 or $10,000, I guess.
$5,000. That's what I was thinking. 5 or 10 grand. Sure. Yeah.
I think we paid 10.
Okay. 10. Yeah. That's, sounds market.
Yeah. And I did see one that was 15. And so, that's kind of the range, I think, of like the better people that I talk to.
Absolutely. But no, and I appreciate that about you too, is like, you understand the value of advice, especially when there's a big potential upside. Hey, don't spend 10 grand today, but lose a potentially $1 to $2 million tax break in 5 years. Do the discounted cash flow analysis, like small investment.
Yep.
Right. Like literally, if you had the right to invest 10 grand now to get that in 5 years, pretty easy decision actually.
Yeah, exactly. And yeah, I mean, even like my bookkeeper, it's like a CPA roll up from another searcher.
Yeah,
like they didn't really even know anything about this. So I was glad that I came in armed with the information, so that I can make sure that we stay, within status of QSBS on an exit, because it'd be easy to just coast and then something gets missed.
And it's like, and in parts of the deal, like it's one of the biggest potential returns, actually.
Yeah, it actually is. I haven't considered it that way, but yeah, it is. And
which is weird, right? Because it in some ways has nothing to do with whether the business does well or not.
Yeah, no, it's literally just outside of all of that.
Yeah.
And did you follow the steps or not? So
right. And I guess, and this is my, and I now when I talk to new searchers, I say two things I think are the most important. One, working capital. That's another conversation, we can have down the line. And tax planning. And I think they're both just completely overlooked as like so much value there. And then we spend hours on like little reps and warranties, and it's like, here's a $2 million tax break, and here's like basically meaningless rep or warranty. Let's spend 5 hours on the rep and warranty. And I just kind of like beat that drum with people, and this has been so helpful to learn from you and your experience. There's just so many ways why this is the way to go. In fact, I mean, there's a few situations where it wouldn't apply, but otherwise, I mean, it's just a no-brainer. Every searcher class that they're doing now should be like, there should be a whole module on this.
Should focus on this. Yeah. And the best part is, like, if you're really concerned about whether or not the C Corp's the right thing for you, you can have a management company that's an S Corp. And I didn't set it up that way because that was a complication layer that I didn't want to deal with. But the tax attorney recommended it. And, if you want to separate from the C Corp to a degree, then it's just being a management company. You pay a management fee too, which then pays your salaries, your benefits, your fill in the blank, how you want to do distributions.
Interesting.
That can be a little different. Yeah. So there are ways to play the game and really far.
So a bigger company would do that and avoid like the double taxation, get the S Corp, benefit, for dividends or whatever.
Yep. Exactly.
Interesting. So that's another, I mean, granted there's additional expense with that, but that's another way to make this even more palatable. Wow.
Many ways to skin the cat of QSBS.
Absolutely. Daniel, thank you so much for joining us and filling us in. So psyched, all the good things that are happening. And this is a huge benefit for other searchers. Really appreciate your time.
Yeah, absolutely. Happy to help. And if anybody has questions, I'm always here.
Cheers.